Hello everyone, welcome to Commerce Logic. Today we are going to discuss about cost of equity. This is part 9. So now we shall discuss about equity. Before going into the discussion about cost of equity, we shall talk about this equity. In simple words, equity is nothing but ownership and value of ownership. If someone invests his own money for some invest in any of the investment purpose with the expectation of some returns, so he expects some return on his investments. So and that person vests with ownership, and that value of ownership is called equity. It represents the ownership interest in a company, typically in the form of shares or stocks. We all know that the persons who held equity shares are called as equity shareholders. We also call as equity shareholders are the real owners of the company. So the persons who held equity shares in a company, we are calling them as actual shareholders. That means the persons is vested with a part of ownership in a company. That is the reason why we call equity is nothing but the value of ownership. Now we shall see about cost of equity. Just now I said that every investor will invest in a company or in any of the investment purpose will invest with the expectation of a return. So that return will be called as a cost of equity, and this can be calculated in the following methods where I have mentioned. First one, dividend method. Second one is constant growth method. Third one is earnings method, and fourth one is capital asset pricing model. And now we shall go to dividend method. This is also called as no growth model or price method. The market value of a share depends upon dividend expectations of equity shareholders. The name itself is saying that this method is going to depend on dividends which are expected by the equity shareholders. That is why it is called as dividend method. And now we'll see no growth. Dividend means the firm is following the policy of 100% dividend payout ratio and no profits returned by the firm. The profits are being distributed by the company to the shareholders, and it is not retaining any of the profits in the firm in this dividend method. And now this is the formula for calculating this cost of equity. And next we will see about constant growth model. Under this method, dividends may be assumed to grow at constant rate, and because it is growth method, that growth is denoted by G. Here in this method, it is saying that it is growing. What is growing here? Dividends are growing. Because they are growing, we are denoting that as G. This approach emphasizes the investor actually expects to receive from the investment in a particular share in terms of dividends. We all know that shareholders will get dividends. In addition to that, the expectation of the equity shareholders is that the dividends may increase constantly. That is why it is called as constant growth method. So here the shareholder is getting dividends plus his expectation is increase in growth of this dividend. That is why it is called as constant growth method. This is the formula for constant growth method. KE, it is cost of equity, and this is dividends, and this is issue price, and this is growth. So G for growth rate, PO for issue or market price of equity. Next, earnings method. This is measured by earnings to price ratio. It is the ratio of earning per share to market price per share. Then this is the formula where E equal to earnings, and it is nothing but earnings yield ratio, where price equity ratio is MPS by EPS and earnings yield ratio is EPS by MPS. And this is last method, capital asset pricing model. Any rate of return including cost of equity capital is affected by the risk in this method. If the investment is more risky, generally the investor demands high rate of return. We all know that if we invest more, then we expect more return. If we invest less, then the returns also will be less. Then next, the equity shareholders receive dividend only after the payment of interest and preference dividend. We know that these are the actual shareholders of the company and bear losses of the company and profits of the company, but they also receive the dividends of the company, but subjected to a condition that payment of interest and preference dividend should be done first. Only after that they have to receive the dividends. Next, it means returns on the equity will be unstable. The equity shareholders is going to receive the dividends only after paying the interest and dividends to preference shareholders and other creditors of the company. So there is no stability for them to obtain dividends, and the cost of equity is higher than all the other cost of capitals. Next, the CAPM explains the behavior of security prices and provides a mechanism where investors could assess the impact of proposed security investment in their overall portfolio risk and return. So this explains the behavior of security prices. CAPM describes the risk-return rate of securities. Cost of equity will be under the formula. This includes risk-free return, and then beta is security, that is coefficient. RM is nothing but return on market portfolio. Then these are the 4 methods of calculating cost of equity. Thank you for listening to me. If you like it, subscribe my channel. Thank you.